Hey, Bill. All right, now that we've scared everyone off with the recording, I see 2 passed. So I'm gonna get started because we've got a little bit to chat about. Seems like we've got a big group too. So first, let me slow down and introduce myself for anyone I have yet to meet on this call. My name is Samantha Beeler. I'm your lead president here in the Southeast, and I have been, like many of you, deep into the headlines over the last 2 weeks. And making sure that we are keeping track of what's going to be quickly evolving environment in our economy, as well as just what credit unions can do during this time to reassure our members what you all are doing every day to help them through kind of an unknown time. But also, we have had a number of good conversations this week that I wanted to share and impart with this group. 2 of those include conversations. The 2 of those include conversations with Jim Nussel. We heard from him at our executive dialogue. He flew down to Fort Lauderdale to give us a pretty in-depth update on the situation, as well as that afternoon we also talked to Graham Steele, the undersecretary at Treasury that some of you got to know very well during the CUNA GAC. I can tell you the tone was a bit different on this call than the quite a bit of time he gave us in DC. He was, on a really tight timeline, headed to a press conference, staffing his boss. Treasury is in the thick of it. So I wanted to share some of the feedback that we've gotten from that. We've also asked, there he is, Dawit Kabede from CUNA to join us. He's one of their economic experts. And so we wanted to make sure we had that perspective on today's call. We also, of course, have Grace Newcomb, our Vice President of Communications and Federal Advocacy, and she'll share a little bit about what we're doing on the policy side, because I want everyone on this call to hear clearly, and you've heard for years, and you're astute folks, Congress doesn't waste a crisis, and this is a banking crisis. To what extent? Luckily, our tolerance for crises as human beings right now is very high, so sometimes this feels very navigable. But had this happened just a few years ago, it would have felt, I think, like a much bigger impact. That said, we want to make sure that in any time like this, we are postured to be proactive, not reactive to the situation. But there were a few things like the CLF modernization that we were already negotiating, like the increase of the $250,000 insurance insured limit. We had already talked to the NCUA about that back in December. So these are moments in time where we have to galvanize our legislative and regulatory strategy to move us forward. And then we've got David Pace, our manager of regulatory advocacy, our resident expert on all things crypto, our blockchain expert, and just does a great job tracking the markets, making sure he's staying close to what the regulators are saying in these times, and where we can interject our viewpoints if we have credit unions. But I also want to make sure we hear from you. We've done quite a bit of sending email messages and talking points, but we want to make sure that we're facilitating conversation here today. If there's anything you all need more of, it's the time to let us know, or if you just have questions for your peers. I've only heard from 2 credit unions about very, very large depositors coming in that were concerned. Both times those were able to be quelled, and there's only one that I know of, not in our footprint, a credit union that did have to go ahead and be really proactive with their members because they were having a number of folks come in. Anecdote, one was asking for their deposits back in gold bars and was told that was not possible. So let's move ahead. I will share first what we heard in our Treasury conversation. You all know how we got here because you've been living it. So the biggest thing we were able to talk about with Undersecretary Steele was the concern that many of you have shared. I mean, I appreciate you all forwarding these headlines and these talking points, because we were hearing them from Yellen as well. This idea of large institutions having some kind of insurance differential in how their insurance is treated, that because they are SIFIs, because of their impact on the economy, the way they get insured looks different. And I know what they reiterated to us is this is a game time administration decision. And it was so good to hear Jim Nussel, scary and good to hear Jim Nussel talking about his time back at OMB when he was called in 2008 crisis into the Situation Room to see how big that check needed to be to kind of, keep the economy afloat. And what we were trying to get across to Treasury is that's not this scenario. This is not the blank check, the contagion language that Yellen has been using has also been well, I'll say it as strongly as we did in that context. It's a poison pill to smaller institutions, because then the money, the outflows are going to predominantly, now some of our credit unions have seen them, but they go then predominantly to larger institutions, because the fear that drove them out of their current banking relationship is going to drive them to these depositors where they're being told that they have unlimited insurance. And so at the same time we were talking with Secretary Steele's office, Yellen was up on the Hill, and they both said very different things. Yellen said 250 is enough, and made a very strong statement. And then the undersecretary said Treasury's not taking a position on it. So our ask as an industry was include this in the after action assessment. Treasury is going to be very hands-on with the FDIC and the Fed in their after action report from SVB and in Signature and others. And we want to see modeling of what this crisis would have looked like had the insurance limit been at 500 or $1 million. And if they can create that modeling, we actually think, and I think some of you know this, we have people in the industry, some big presidents who worked at Treasury during the time of the crisis. That's been done once before, but then it was put in a drawer. It was 2 years after. It didn't feel like it was as pressing as it was during the time of the crisis back in 2008. And so by the time Dodd-Frank and the CFPB were being rolled out, that research had just kind of, put in a file folder and shipped off to a warehouse somewhere. We want to see that brought back to the forefront, what research can tell us what the right deposit insurance amount is, because it hasn't even been indexed for inflation. That alone would probably help with consumer fear. The other thing, and I think it's important that we talk about, is our differentiating ourselves as an industry. We don't want to run the risk, and it is a risk that we would be, as they look at safety and soundness, that the industries would be seen as, potentially needing to all have one regulator. We've heard that conversation before. It's not new from this administration, but this idea of our independence being a risk to financial services. And so we really highlighted the strength of our share insurance fund. We highlighted the strength of our provincial regulator and how well they've responded, and how safe and sound credit unions are. And I think it's important, because I don't want it to get lost on this group, that even before this crisis, the CFPB assessment aside of whether or not what the CFPB should be and what it is, and its future structure, its legal structure, all of that conversation aside, there was already a sentiment in Treasury that we needed to do more on risk. And we needed to, I wouldn't put it past Treasury to consider another, alphabet soup addition to, and hopefully to their office, I think is what they would think. But we know that the NCUA is very focused on risk, right? And our provincial regulator, I will say one benefit we can see from this is a refocus on safety and soundness, and maybe not some of those periphery issues we've been talking to them a lot about. In fact, a number of you have been on those calls with us as we've talked to Chair Harper's office and some other members, and it's felt like they were focused on things kind of outside of the scope, or maybe were too far of a reach, and they were really looking at things that weren't about safety and soundness. And so I think this will be a good refocus. And it also allows us to have modernization conversations around the CLF, like I mentioned before. And I think that those will be really helpful, because it's also about liquidity. We can start to, the NCUA is eager, it feels like a fair, eager to reframe this idea of that being the last stop, that it's, the end of the line on liquidity. I think they'd like to see it being used differently. So I'll stop there and see first if there's any questions for me on our conversation with Treasury, any other priorities you want us to be escalating to them. They were very appreciative of the anecdotes that some of you had sent me around members coming in, what they were asking. Some of you have sent me just how much the insurance estimator note of deposit, we'll talk about that piece, but how much it was getting utilized on your sites, how the NCUA one isn't necessarily the easiest to utilize. And so just little technical updates like that are also very, very helpful for us, because those are problems we can solve quickly. And I'll actually go quiet so you can ask questions and scroll through. See nobody coming off of mute. So I'm just going to take a personal point of privilege really quickly, because as I scrolled, I saw Kelsey. So I want to take a moment to introduce our newest expert on the association team. Kelsey Davis, she joins us from Alabama Credit Union. She's our new compliance expert, and we're very glad to have her on the team. So Kelsey, if you just say hi so people know which box you are.
Yeah, it's me over here. But it's very nice to see everybody's face. I've been enjoying getting to meet everybody and getting going with LSCU. It's exciting.
I'm glad to have her. As you can imagine, it's a time to have more great compliance team members. So, all right, I didn't see any bold folks coming off of mute, so we can keep moving. Next, we want to introduce Dawit Kabede. I hope I am saying that. Dawit, please feel free to correct me, but I have been able to hear from him, read some of his articles. I think he has a great sense of what's happening. He works with Mike Schenk, who many of you know well. And I'm excited for his perspective on what we can expect. Obviously, Wednesday's measured response, 25 basis points. What does that mean? And what's the safety and soundness look like across our industry as well as the banking industry? So with that, Dawit.
Thank you very much, Samantha. I'm going to start sharing my screen. So if Grace, if you can allow me to share my screen, that would be great. All right, can you all see my screen? All right, great. So yeah, I will be talking to you about the economic and credit union update, but I'm going to start my presentation with different macro trends on the economy, because it will help us to understand what the action that the Fed is taking. And then after we discuss that, and then we will discuss about how that is impacting the financial stability that we have been witnessing in the last 2 weeks. And then finally, I'll talk about credit trends in credit union operations. So if you look at this slide, it shows you the economic growth in the last 3 years. So you can see in 2020, we have a decline in economic activity, 2.8% down. And what happens during that year was, the Federal Reserve lowered interest rates and started buying large scale assets to stimulate the economy. And what happened is, in next year in 2021, the economy recovered fast and strongly. And during that time, I think it's starting in April of 2021, we started prices to go up. So inflation starts to climb that time. And 2022, fast forward to 2022, the Fed starts to tighten monetary policy, increase rates, and reduce the size of its balance sheet. Economy, and because of that, economic growth starts to decline in the first half of the last year. So we had 2 consecutive negative GDP growths, but the economy was able to come back quickly, and we ended the year with a 2.1% growth. So that is what was considered as growth at potential, coming down from 5.9 the previous year. So what happened during this time is you can see that consumption and domestic investment are the major contributors to the economy. And when the Fed starts to reduce the balance sheet and raise interest rates, we started some movement in the components of these 2 categories. So this slide shows you, for example, that in post-pandemic 2022, the shift in consumption shifted from goods to services. So you can see the quarterly annualized growth rate for goods was negative in the last year. And residential investment also took a hit. So you can see these double-digit declines in housing investment last year, because mortgage rates start to go up beginning in March, and they remain elevated. But service spending is still very high, and it is actually carrying the economy. And you can see that we have quarter to quarter large increases, but we have also seen some softness in the last quarter of 2022. So considering what's going on right now, you can see that the decline in residential investment will continue. Tracking, data from the Census Bureau on housing permits, starts and completions, we have seen a continuous decline in new permits and starters beginning in March, and then completion remained the same because those are constructions in the pipeline. But as monetary conditions tighten, developers are not taking new permits to build. And the current crisis also means that funding from regional banks is going to be slower. This is in addition to the expensive borrowing cost because rates are higher. But regional banks are a significant source of finance for commercial real estate and also overall in mortgage throughout the country. So combined with high cost of borrowing and tighter credit standards, we expect to see further decline in construction and residential investment, which means further decline in economic activity. So if you have seen the news on Wednesday, the Federal Reserve, when it decided to raise interest rate by 25 basis points, it also released a projection document. So in that projection document, the FOMC member C economic growth by year end will be 0.4%. And if we see the real-time tracking of economic activity, the Atlanta Fed has the first quarter tracking right now at 3.2%, because we have larger than expected spending in January. Q1 is forecasted to be strong. Although we expect this 3.2 it may decline because February spending was lower, and then March spending might also be the same. But still, first quarter is going to be stronger than expected. What that means is if the Fed is seeing 0.4% growth year over year, that means there is a significant slowdown ahead in the economy. So when we look at the labor market, this has been performing really well last year. 4.8 million jobs were added. In the first 2 months of 2023, 800,000 jobs were added. So in a normal time, this is considered as good news. But when it comes to the fight against inflation, this good news is actually bad news for the Fed, because the Fed is expecting some slack and slowness in hiring for inflation to come down to target. And you can see strong labor market is also correlated with strong spending, which means strong consumer demand, and that makes it difficult to reduce prices. So unemployment is also at record low, 3.6%. In the last 2 months, when we see unexpected, large increases in hiring, we have also seen, some news that the Fed, some trends that the Fed considered as good news in terms of labor supply. For example, the prime age employment to population ratio, which is, looking at employment of people between 25 and 54, has gone up, and it's back to pre-pandemic level right now. And last month, when the economy added 311,000 jobs, participation also increased slightly, and 400,000 new job seekers joined the market. And looking at the, another survey that tracks job opening and labor turnover, it shows that, quit rates, although they are moderating, are still very high. So there is still, even though there is a slight increase in participation, demand is too strong. So people are shifting, voluntarily leaving their jobs to in search of better employment and better wages. And the gap between the unemployed people and the vacancy available is really huge. So what this means, so if you see this graph, it tracks the unemployment level to the total non-farm job openings since January of 2019. You can see pre-pandemic, openings were slightly higher. If you go back in history, the relationship was inverse. We have more people seeking jobs than than there are jobs available. But post-pandemic, as the economy recovers, the gap between unemployment level and job openings has widened, and right now we have almost 1.9 job openings per every unemployed people. So what the Fed is expecting is the Fed considered it a very tight labor market that is inflationary. So in a soft landing scenario, like 5 or 6 months ago, the Fed was saying that, if they are able to, narrow this gap, it is highly likely that, a soft landing is possible because they will be able to bring inflation down and slow economic activity without the need to increase unemployment rate, as far as this imbalance is corrected. But right now, this gap still is wide, and conditions. Even though it's almost a year now that rates are going up, inflation is still very high. So February inflation report indicates that year-over-year inflation is 6%. And that is lower than what we have seen, like the peak in back in June. But this rate is still very higher than what the Fed considered to be a target or long-run objective for the economy. And right now, if you see the different components that are contributing to this headline inflation, you can see services are the main drivers right now. So like a year ago, it was goods, and then the Russia-Ukraine war, because of that, energy prices were the leading contributors. But right now, services are the main drivers of inflation, and 6% also includes, shelter inflation in the CPI, which contributes for almost a third of the weights in the overall inflation, and about 42% for core inflation. But shelter inflation in the CPI is a lagged indicator. What that means is, if you see this graph that tracks, market rate in rents to the CPI shelter index, you can see that the CPI is slow in capturing the increase in market rates, and it's also slow in capturing the decline. So right now in the market, we are seeing rents, going down, but every month you can see that the most contributor to inflation right now is housing. So in fact, in the last report, 70% of the month-to-month inflation was due to housing. So researchers at Boston Federal Reserve conducted what the impact would be if all this lag is included in the CPI, and then they forecast that there will be a 1 percentage point decrease in headline inflation and 1.34 percentage point decline in core inflation once all these market trends are incorporated in the CPI. But even when you include that, right now it's 6%. So the underlying inflation is 5%, which is still very high, compared to the Fed's long-run objective of 2%. So because of this reason, because labor is stronger than expected, inflation is not slowing down as expected, the Federal Reserve continued to raise rates. And that is why also, on Wednesday, the Fed raised interest rate by 25 basis points, even though there was a lot of expectation that the Fed might pause because of what happened in the financial sector. So this graph shows you for example, here in the 2 years between March of 2020 and March of 2022, the Fed funds rate were close to zero. And what happened during that time is also, we said there was a decline and then a massive strong economic recovery. But there were like in the financial institution world, we have seen like a massive deposit increase because one, people were not able to go out and spend, and then there was government support. So there was a large increase in deposit inflows. Saving rates were to the roof. And if you see like overall loan growth also, that was also weak compared to long run trends during these two time periods. So what financial institutions did during this time was, some of them invested that money in bonds, or in some of them in safe bonds like treasury and mortgage-backed securities, because they are considered as safe and sound. So if you see the trend, this is data from FDIC in long-term bank loans and investments. You can see, how this moved between 2020 and 2022 as the year goes on. So the long-term investment, 5 to 15 years and above 15 years, has actually gone up during this time as institutions invested in, long-term maturity bonds. But we know what happened during this time. So like rates have gone up like from 0 to 4.83. And we know the relationship between, market interest rates and bond prices. So if interest rates increase by 1%, the value of the bond declines. So there is an inverse relationship between the two.
The thing that separates champions.
So for example, if we see if someone has a 5-year treasury with a 2% coupon purchase, and during this market environment, the duration, which is the discounted present value of the weighted average life, is 4.5 years. So if interest rate goes up by 1%, we said the value of the price of the bond declines by the same amount for every year during this period. So if we want to see the decline in the total bond price, you have to multiply by the duration by the change in market rates. So market rates almost changed for like these treasuries, like 2.5% during this time, and that implies the value of those bonds declined by 11%. So that's a huge loss. And if financial institutions or investors don't have to sell these bonds, it's not a problem. Because these are shown in the books as unrealized losses. And actually you can see here, data from FDIC, it shows you the trend in unrealized losses for debt securities between 2020 and 2022. And you can see that as rates start to go up, the value of the unrealized losses becomes really huge. So you can see some of these are, held to maturity, but some of them were made available for sale. So this is an overall trend for the banking industry. But if we look at, what happens to the 4 banks, 3 of them that failed, and First Republic that was struggling last week and still working through that problem, you can see that the amount of debt security as percentage of the assets was very high for these banks. So take, for example, Silicon Valley. So Silicon Valley had, before the bank run, has 55% of its securities in long-term mature bonds. Signature Bank was a little bit lower, about 25. But what makes all these banks common is they have a higher share of uninsured deposits from what they have. And Silicon Valley uninsured deposit rate was 95%, and signature was around 89 to 90%. So what happened is, so these companies have, higher unrealized losses in their books. So if we take Silicon Valley, for example, the capital ratio, without including the unrealized losses, actually is above 10%. But if you include the unrealized losses, if those unrealized losses are included, then it's there. It was basically insolvent. So what happened was this Silicon Valley Bank has also serving some of its large depositors, for example, who control these deposits, wanted their money out. So that forced the bank to realize its losses. And then that led to the failure of Silicon Valley Bank. If we compare this, with credit unions, you can see that the most credit unions have, smaller proportion of their assets in debt securities, and most of their deposits are insured. So these bubbles are weighted to show the size of the asset size of the institutions, but you can see that most credit unions have almost 92% of their deposits are insured, and most of them do not have investments in long-term maturities. Actually, if the unrealized losses as percentage of assets for credit unions was only 1% out of Q3. So this shows again, it's the same graph, but just taking out the four banks, you can see that if you just not looking at by asset size or anything, you can see for all credit unions, the median debt security as percentage of assets is 5%. So if you see the 10th percentile, the 50th percentile, then they have no long-term debt maturities. But in the 75th and 90th percentile, we have some credit unions having, 21% or 31% of debt securities as percentage of assets. But when you see the uninsured deposits as proportion of assets, the median is 3%. So most of credit unions deposits are insured. So if we look at, by state, for example, I have here the three members of the Southeastern Credit Union Leagues. For Alabama, for example, the percent of insured credit union deposits is 91.7%, but the rate, it ranges between, minimum of 78.7 to 100% insured. In Georgia, 92%, and the range is between 67 and 100. In Florida, for the state aggregate, almost 93% of the deposits are insured, but the range it varies. But again, I just want to stress that, so I looked at some of the minimums, the minimum uninsured deposits, and most of these are very, very small credit unions. Some of them less than, 5 million in assets, and don't engage in any investment of long-term maturities. And if you compare their net worth ratio, which is well capitalized, some of them even up to a high, the small credit unions usually have high net worth ratios, and they have the same capital ratio. Their capital ratio, including unrealized losses, is the same as their net worth ratio, because they don't engage in long-term investments. So we can say that more credit union members, they have most credit unions have higher percentage of their insured deposits. They are well capitalized. Their net worth ratio right now, which which doesn't include unrealized losses, is above 10%. If we include unrealized losses for the movement as a whole, it's 9.2%. So there is no, exposure to that kind of duration risk that we discussed earlier, overall as a movement. So we have seen, like, some people reacting to this. So a Morning Consult survey shows that, some people are withdrawing their money from, banks. So for example, this one shows you like 16% of the people who moved their money out of regional banks. It just showed them, where they deposited their withdrawals, and 80% of it is deposited at credit unions. And then we have learned this also, anecdotally from the calls we have with some credit union members. They have seen. I talked to people who have seen, ACH transfers coming in from, the Silicon Valley Bank in that area, for example. So who's moving the money out of these banks? So most of them are millennials and high income earners, and more likely to own crypto. So these disaggregate the people who move their money from these regional banks. But these are the main points that we see. So when we look at, trust in banks, so because this is what is in question, or when a crisis like this happens, that's what people are questioning. So with the survey shows that, there is no, significant difference, people who are moving money and people who are not, when it comes to their trust. But CUNA conducts, voters poll every year. And we ask a question on trust, service, and community focus. And we usually, credit union members respond very positively when it comes to trusting their institutions compared to non-members. Of course, this survey is conducted before the failure of Silicon Valley and the other banks, but this is the same result also we see every year. So 94% of credit unions are more likely to see, to feel very positive about the trust they have in their institution compared to 86% of non-members. And if we look at responses to like strong positive responses in terms of trust, we see that credit union members are actually 1.6 times more likely to say that they trust their financial institution, their credit union, more than non-members. So CUNA prepared a lot of resources in order to help credit unions get answers vis-a-vis to the deposit rates and what happens in the financial industry right now. And you can go to this website and get this information for yourself. And some in the popular press are also indicating that credit unions are one of the safest ways to move money if people have accounts above the insured amount of $250,000. So this article from Forbes shows talks about credit unions, that credit unions are deposits are well insured, and also highlighting some of the services that credit unions provide to their members in terms of better loans on deposits and better rates on deposits and better rates on borrowing. So this graph just shows you the insurance fund ratio for the NCUSIF and also the banking for banking institutions. And you can see that in the last 30 years, the NCUSIF is well funded, well capitalized. And actually, the FDIC insurance fund was in the red twice in the last 30 years. So yeah, as Samantha mentioned, at the beginning, there are a lot of policy questions. People are talking about should we, insure? Should we increase the coverage for deposit insurance, or if we are going to raise it to, what should it be? Is it 500,000 or a certain percentage of that? What is that level? So that discussion is also ongoing. One of the things that the Federal Reserve did after Silicon Valley failed was to increase the discount window lending and also a bank term funding program, and we have seen a large spike in financial institutions taking loans in these two programs. So there are also a lot of questions about the bank term funding participation. What does it imply for the Fed when it's extending loans or on these bond values on par basis? What's the implication? Is there any other systemic risk that may arise out of these? So this is still a discussion that's ongoing. So I like to also put some of these trends on credit union operations. Some of the things that we have been talking about is liquidity. Credit unions overall, like when you see it, like in 2022, they had a very high year in terms of loan growth, almost 20% increase in loan growth, and the saving was also low during that time. And in fact, that's coming out of a lower growth in the prior years, but we have seen, an increase in loan to savings ratio, meaning, the liquidity levels were lower. And we think this also will likely continue throughout this year. But this is something that we are seeing movement-wide that we like credit unions to be aware of. And saving growth, was also very low last year, only 3.7%. Again, this is coming from higher saving rates in the prior years. But credit unions now, some credit unions are, issuing, certificates of deposits at higher rates to increase savings, and because of that, we think, savings will slightly go up in this year. Again, we will be updating this forecast in April. This was done in January before all these things that are happening were in our assumptions. They were not in our assumptions when we were doing this forecast. So another positive news is, credit union borrowers are paying their loans on time. The last 2 years we have, lower delinquency and net charge-off rates, but we are seeing a spike in increase in, for example, auto loan delinquencies, and we think this is something that credit unions should also be aware of or should be tracking, because right now, so the delinquency, the denominator, which is the outstanding loan balance, has grown significantly last year. It could suppress the actual trend in delinquency, and the Fed is forecasting economic slowdown and probably a slightly increase in unemployment. The delinquency rate might go up a little bit, but our forecast it says it will not be higher than the long run trend, but it is very important to track these or to take this into consideration in their operations. Earnings were also very high in the last 2 years. Some of it because loan loss provisions were lower than normal, because I said credit unions assumed expected a high default rate at the beginning of the pandemic. So as I look at it, high loss provisions, but that didn't happen because borrowers were paying on time, so loan loss provisions were down. So earnings were very high in the last 2 years. So we expect, loan loss provisions to go back to normal, and also, the inverted yield curve also impact, adds a pressure on credit union earnings. So we think that will go down to 60 basis points, slightly below, the trend in the last 5 years. So I like to end my presentation here, and I have the appendix here, like our forecast. If you want to access this information, you can go to cuna.org/statistics to get to download the file yourselves. But now I'd like to end here and answer any questions if you have any.
Thank you so much, Dawit. That was fascinating for someone like me. One of the slides that he brought up was the stair step of the economy of the rates that have increased, and it's the steepest stair step the United States has ever seen. Post any recession, Great Depression, any of it, it's the fastest rate increase that we've seen. So hence how we find ourselves here. Any questions for Dawit? Okay. Well, we know where to get in touch with you. Thanks for all of your work. It's been really, I will say, just shameless plug for the CUNA League system. The last 2 weeks have been an amazing example of how, when we work together at the state and federal level, we're more effective, and our conversations with our state regulators have been informed by some of the data that we've been able to pull from CUNA and share, and vice versa. We've been having lots of conversations with our delegation. And so with that, I turn it over to Grace. Like I mentioned, this, of course, spurred quick conversations with Capitol Hill, and they've been hard at work to wrap their minds around what's necessary. And some of it comes down to advocacy priorities we already had in place, and others really raise a concern or questions around things that we think credit unions are a good solution for. And so with that, Grace, if you want to talk a little bit about the legislation that this helps advance.
Definitely. Thanks, Samantha. And again, thank you all for joining us on a Friday morning. Right now on the Hill, there have been a ton of conversations as to who is to blame for what is happening. And right now, there is no consensus among either party as to whether this was a result of rollbacks that took place under the Trump administration. That has been the aim of a group of Democrat senators led by Elizabeth Warren of Massachusetts and Katie Porter of California. However, there is not even agreement among the Democratic Party that that legislation is what resulted in this failure of the banking system. Instead, there were Democrats who had their hands just as much in that legislation as Republicans. So it's putting certain members of the Democrat Party in a very vulnerable position, which has led Majority Leader Schumer to say that, there needs to be a very thorough and extensive review and study done. So next week, we're going to hear for the first time from executives from SVB and Signature Bank who are being called to testify before Congress. Senator Warren is very interested, like I said, in rollback of the previous stress test for those mid-sized institutions. But like I said, Schumer and other key leaders have indicated there's no appetite for such an overhaul. So as it relates to insurance limits, there is also no consensus as to what that base would look like. The most commonly discussed increase would be $500,000. But again, there is no agreement in either party in either chamber as to what that should look like. So until testimonies start happening next week, that is when the real discussions and real steps forward will be discussed, I believe. And I will say that our regulators, the Treasury that Samantha met with earlier this week, they have all indicated that this is something that Congress needs to look at to fix. So, as Samantha indicated, we are ensuring that credit unions continue to be in the discussion. We're discussing the health, the safety, the soundness of the credit union system, and also highlighting the differences of credit unions compared to banks to our federal partners, which has been very well received. I'll let you know our delegation in all 3 states have been very reassured at the high levels of insurance amounts that Dawit just discussed with you all. So we've had very positive conversations about the uniqueness of the credit union structure. As it relates to CLF, we are using this as an opportunity to allow greater flexibility for credit unions to purchase liquidity stock and extend agent membership to our corporates. You all will remember that's something we've been working on. We've been working on this since the CARES Act. Unfortunately, there were certain Republicans who were skeptical of extending anything even remotely associated with the CARES Act. However, this crisis has resulted in a renewed support for CLF extension, including from key Republicans on financial services who previously had been a little skeptical, like I mentioned. So we're using this to push CLF. Our last 2 priorities, we're kind of coming at these from the same strategy. Dawit mentioned that 18% of SVB Signature Bank customers have gone to credit unions to open accounts. And so if credit unions, and if we are looking to diversify funds and deposits, because as you all know, this high concentration of riskier deposits is what ultimately one of the reasons that led to these collapses. So if credit unions are expected to open their doors and accept these former customers, new deposits, then lending caps and field of membership restrictions should be considered. So these last 2 issues, we're waiting for the right time to insert these into the conversation. But as we discussed earlier, no good crisis will go to waste, and we will ensure that your priorities continue to be discussed and considered at the federal level. Any questions on any of the legislation that we're seeing or expect to consider? If not, real quick, we'll hop into some of the resources that we've been sharing, and we really want to hear from you all and what you're hearing from your members, how we can be more helpful to you all. We want to ensure that you guys have the talking points needed to respond to media and member inquiries. And on that, we've heavily discussed the healthy state of credit unions today. And because of that, we hope you all will feel confident in speaking to your local media outlets on just how safe and healthy credit union deposits remain, to reassure members in your local communities, and also hopefully accept new business. We're working on, with our communicators from across the country, a more comprehensive media kit that will create some sort of consistency in messaging. Credit unions were born out of adversity, and you also have, stood the test of time. And so you guys are local. We've been stressing the importance of banking local, keeping your money local. You all have probably seen and heard there have been some troubling comments made in certain committee hearings. And so we're ensuring that consumers and lawmakers understand the importance of keeping money local. While Greg, you mentioned, the deposit amounts may vary. We want to ensure that you all have, the resources that adequately reflect your institution. But also, if we have some sort of consistent tagline, ICBA has done a great job of controlling the messaging, but almost too much. They've really oversaturated social media, you may have noticed, but we want to ensure that credit unions are reassuring the public just as much, because as you all know, credit unions remain safe and sound. And we touched a little bit on the account insurance estimator that is easy to use, and know that our team is available to help you all. Reassure your members that their accounts are protected. The #1 search on Google this past week has been, is my money safe? And so we want to work with you all to reassure your members, the public, and lawmakers that credit unions remain safe and accounts remain protected. Before we turn it over to David Pace, any questions for me?
Grace, I did get some inquiries, and yes, we'll send out the materials from this call after the fact with the presentations as well. So.
Definitely. Thank you. All right. We will turn it over to David Pace, our Manager of Regulatory Advocacy.
Thank you, Grace. And I'm going to keep it very, very brief, just given the time. And DeWitt and Grace, you've both done a fantastic job of already covering many of the things that I would talk about. So one thing that I would add on to something that you mentioned, Grace, was the adjustment to the insurance level. One thing that we should note is that both the FDIC and the NCOA really have not come out with any solid comments on that matter. They're not taking a stand, which is kind of what you would expect from a regulatory body like that. And the push in that regard has mainly been more political in nature. However, at the credit union level, something that we are seeing is, as DeWitt mentioned, and as you mentioned, Grace, is the inflow of deposits into credit unions. And I feel that this is a reflection of the faith that your average person has in the credit union system. The fact that they know that it's a local institution, that it's someone they can trust, and that their money will be insured, just as it would be insured at a big bank. So we are seeing at a very high level these sort of moderate inflows of deposits. And while instability, there might still be some instability in the regional bank system, we expect the credit union system by comparison to be very stable. If you want to go ahead and go to the next slide. I feel DeWitt has already done an excellent job of covering this. He's already gone over kind of what triggered the bank collapse, uninsured deposits, risk concentration, all that fun stuff. So in order to give the maximum amount of time, we have a whole 3 minutes left for questions in general. So I want to open it up to the whole group. What sort of questions do you all have about this situation we find ourselves in?
You can count to 10 till we see someone come off mute. How about this? I'll throw a question out to any of you all. What are you hearing from your members? What are you hearing in the lobbies? It's pretty quiet.
It's very quiet here, Samantha, in Auburn. We've maybe had one question from a member, and so very little talk. A lot of social media stuff happening about it, but I don't know that creates a lot of adversity in the branch, so to speak.
Yeah, Henry, what a great point. As far as the social media being louder than what we're hearing from our members directly, I will say Grace mentioned that there's a number of different coalitions forming on the Hill, and one of the current rumors, to be frank, because I haven't even seen a group that's spoken publicly, but there is an idea coming from a handful of lawmakers, particularly those inclined on the libertarian side of the spectrum, that we should find a way to be able to control the modern bank run. We need to modernize our language, right? Because this is fueled by social media, and now within a few clicks, members can move their money. And when we wrote our first approach on regulations on a bank run, it was horse and buggy days, right? It was different what that would look like. So I think there has been a bit of a conversation around what we do, to the point where one senator suggested that we should have a hearing with Twitter to see the role they played, which I can imagine we'd all like that theater, but not necessarily that policy. Thanks, Henry. Alan, I saw you come off mute, but I don't want to call you out if you don't have anything to add.
Well, short answer is we're not hearing a whole lot here either. I mean, we've had a bunch of questions about insurance, and we have had a couple of people who want to make large withdrawals, but for the most part, it's been a non-event. Like everybody else, we sent a notice out to our members, and it apparently was very well received. So
Nicely done.
Yeah, Samantha, here in Gainesville, Florida as well, we have gotten a few questions and a couple of phone calls. They actually have seen some deposits coming in. So maybe some of that 18% that are coming to credit unions came to us. So
yeah, I was so fascinated by the statistic that I think it was 44%, but there was a big chunk that said Southern region, right? And obviously that's a large region, but that's the largest region that we've seen money move into. And I conjecture to guess that there is quite a bit of folks who moved this way, who left their money back on the West Coast when they bought their East Coast place down in probably your region, and then they moved their money local. And we'd love to see that. That's actually, to Grace's point, one of the biggest talking points we've had is not necessarily calling out the banks who are also, federally insured. We don't want to, glass houses, right? But talking about how nice it is to have your money local, in the community where you're at, with people serving the local community. So we're leaning into that narrative quite a bit. All right, well, we're 1 minute over. It's a Friday, and I will offer this. Us hearing from you is the most